Hello, everyone, and welcome to this edition of Investing with Confidence. I am your host, Joshua David, and we are happy to have you with us today. I have my good friend, my good pal. He is the one and the only Mr. Al Conningson. I have him here with me today in studio. How are you doing today?
You know what? I'm doing fantastic, and I can hear some of you people out there saying, thank goodness there's only one.
Thank goodness there's only one. But you know what? It's always
those are
great.
People that know me.
Yes, it's always great to be back talking about the stock market with you, Al. We have a lot of fun in the show every single week, talking about how the financial markets work and how us as regular traders and investors can bring more consistency to our trades and investments to make smarter investing decisions. If you're a first-time listener, thanks for stopping by. We're going to talk about all that stuff here today. We had some big moves here over this past week here, Al. Let's talk about Alphabet, which is basically Google. Wow, they had some earnings on, I believe it was on Tuesday evening.
Correct.
And a stock split, 20-to-1 stock split. Basically, overnight, that stock jumped roughly about $250 per share from the close to the open. Massive moves, great for investors. Actually, right at all-time highs of that stock price. So as we kick off the show here today, I want to talk a little bit about this market rebound. We've been talking about different opportunities as it's been going down the past 4 or 5 weeks. First, before we do that, let's talk about the significance of a stock split with Alphabet.
Yeah, well, you know, Alphabet was up in the $3,000 range, which meant that a lot of people, the majority of the people probably listening to our show, weren't going to be able to put together a large position in a stock that is $3,000 a share. So by splitting like that, it's a wise thing for the company to do because now they have made their stock available to a significantly
to the masses,
larger,
is what they say.
The masses, right? The masses. So that was a big contributor to the move up in the price of it, plus their earnings. So it was a combination of things there. But let's look at what's happened here with the S&P 500, the Dow, and the NASDAQ over the last few days of last week. We had a dismal January for all of the indexes were down. And
I want to say I saw something somewhere that it was the worst start to a year almost ever.
Yeah, it was a dismal start. So what's happened? I think this is a big part of why we had a couple of days last week that had huge moves in all of the indexes. And one of the reasons is that a lot of the funds out there, they don't want to send out reports to their clients showing that they didn't have the stocks that were moving. They didn't want to show such terrible returns for the month. So, and we know that these big firms can manipulate the price of things. So there was probably a lot of manipulation there, driving the indexes up, driving especially the technology stocks up to the point where some of these funds are going to have a better looking month because of what's happened. You know, so that's maybe one of the things that happened. Plus, there's been some good earnings. But the bottom line is, you know, we're going to see a lot of news, a lot of opinions out there by people. You got to shut that out. Don't listen to opinions. Listen to what the market is telling you. It's going to show you things. You know, we talked about Google. I'll tell you a couple of other things. Pull up a chart on AMD and PayPal, PYPL, and look at what happened to those two stocks after their earnings. AMD had a great earnings report. It moved up significantly. PayPal, on the other hand, did not. And I've been saying for a while now, these companies have become so highly overvalued that if there's any kind of a hiccup, any kind of bad news, they're going to get spanked. They're going to get punished. And that's what happened to PayPal.
Yeah, roughly PayPal. Well, actually, PayPal is last couple of days has been up a little bit, but it's been dropping for, since, what's it look like here, since August.
Yeah, look at what happened to it Tuesday evening of last week.
Tuesday evening of last week, there was it gapped lower.
Significantly lower.
Yeah, big time. It dropped about from $160 a share to roughly about 156, so a big drop on that day.
Yeah, and that was a spanking because of bad earnings. So we're going to see these big moves both directions. I think a lot of people that have bought into that buy and hold strategy now are going to find they're going to be disappointed in the returns they get over the next few years because the Fed basically since 2009 has fed this market. The Fed has fed the market by pumping, trillions of dollars of liquidity into the market, And what that's done is it's really allowed the big banks, the hedge funds, to put in bigger positions, and that's really impacted the valuation of some of these stocks. Now that the Fed's pulling back on their quantitative easing, they're going to raise interest rates several times this year, start to reduce their balance sheet. What it means is valuations are going to start to get back down to more normal range.
Yep.
And which means either price has to come down or earnings has to come up to achieve that valuation, or a combination of both.
Correct. Yeah, and I want to correct myself, Al. Actually, PayPal was at $175 per share at the end of Tuesday. Opened up at $138 per share. I wanted to correct myself. That's a major spanking, as you were talking about.
Yeah, and that's going to happen to companies that don't either meet the numbers or the whisper numbers out there. The point is, we're going to have a lot of volatility this year. Where the market starts the year, where the market ends the year, may not be a significant difference, but during the course of that year, there's going to be huge moves up and huge moves down, which is great for traders. And that's what we want to do. We want to show you how to trade this market so you can take advantage of these movements and benefit whether it's going up or down.
Yeah, I'm really glad you brought that up, because average investors only know up markets. We've been talking about a down market the past 4 to 5 weeks here. Great opportunities. A lot of people have been sweating. And what happens is people, if they just sit on their positions, they're wasting time, because time is that one thing we cannot get back, and just missed opportunity. And sometimes it's hard to put a dollar amount on an opportunity, but you know what? Investors are missing out on these opportunities, not knowing how to short the market. That's how to profit in down markets. That's a strategy for that. So we know there's profits for down markets. There's profits for up markets. There's also strategies in the markets for sideways markets. Right. And really, technically, we can call it a sideways market for the past month or actually 2 months here. Mm-hmm. So we teach investing classes here, Al, at Online Trading Academy, locally here in Bloomington. And we get into how these markets actually work, how they function, how the market moves up, the different techniques and strategies to benefit them when the market's going up, and also techniques and strategies to benefit when markets are going down. Even for people that have 401ks or IRAs, there's strategies to protect those. There's strategies to benefit no matter which way it goes. So that's why it's important to understand what they are, understand who's moving the market, and then trade like them. I want to invite people to an investing class here in Bloomington. They're about 2 hours. They're on Saturdays. They're also during the week in the mornings. You can call 952-814-4410 for 2 tickets for this class. When you call in, you're also going to receive a financial quick start kit, which will help you get started right away. There's also some free stock picks in there. If you want to get some free stock picks, call in right now. You can also text the word INVEST to the number 484848. Al, coming up next, I want to talk a little bit more about some earnings. I want to talk about Starbucks. We're going to get into the S&P 500 ETF. We're going to explain what an ETF is. Coming up next. This is Josh and Al. We'll be right back.